Silver didn't just move, it lunged. 86, with January 29th still hovering near $110. Let that sink in. A move from the low 70s to the mid 100s in less than 4 weeks. It's a signal. And the signal is tightness. Not the vague social media version of tightness, the kind that gets thrown around like a mood. Real tightness is plumbing. Real tightness is inventory behavior. Real tightness is what happens when demand keeps showing up, and the buffer that normally absorbs it keeps shrinking. Here's what needs to be understood, because this is where most surface level takes fall apart. A supply deficit doesn't mean the world ran out of silver. A supply deficit means the world used more silver than it produced in a given period, and the difference had to come from somewhere. Above ground stocks, inventories, dishoarding, recycling flows pulled forward, metal moved out of places it normally sits quietly, and when deficits happen once, the system can usually shrug. When deficits happen for years, the system starts losing slack. The shock absorbers thin out, and price, eventually, starts acting like it. 5 million ounces in 2024, 9 million ounce deficit. And the part that should make anyone pay attention is the multi-year picture. The combined deficit from 2021 through 2024 totaled about 678 million ounces. That's not a minor imbalance. That's a persistent draw on the cushion that keeps this market stable. Now, stop for a second, because the obvious objection appears immediately. Because inventory is a category, availability is a behavior. It's possible to have a lot of metal inside the broader system and still have a shortage of the metal that matters at the margin. The marginal ounce is the ounce that actually comes out when demand shows up, at the right place, at the right time, in the right form, under the right rules, without causing premiums and spreads to explode. That's the difference between a market that looks supplied on paper and a market that feels tight in real-world transactions. This is where the structure of silver matters. Silver trades through multiple overlapping ecosystems. There's the futures market, especially COMEX, the commodity exchange in New York, where price discovery is heavily influenced by paper contracts. A futures contract is an agreement to buy or sell silver for delivery at a future date. And most of those contracts are closed or rolled, not delivered. But even when delivery is rare relative to total volume, the futures market still drives headline price. Then there's the London over-the-counter system, commonly associated with the LBMA, the London Bullion Market Association. London is a major wholesale hub. Large good delivery bars move, settle, swap, lease, and get financed there. And that financing layer matters, because it changes what available really means. Then there's the physical world. Industrial buyers, fabricators, refiners, mints, and supply chains. The side of the market that doesn't care about theories. It cares about delivery schedules. It cares about form factors. It cares about whether silver shows up on time, at spec, in volume. When the system has slack, these layers stay aligned. Spot and futures trade in a normal relationship. Premiums stay reasonable. Spreads between delivery months behave. When tightness deepens, fractures start appearing. One fracture is called backwardation. Backwardation is when near-term silver trades higher than future delivery months. In many commodities, backwardation can be normal. In precious metals, persistent backwardation is a stress signal because the system usually rewards time and storage. When the near term gets bid up relative to the future, it often reflects urgent demand for immediate availability. The opposite condition is contango, when future delivery is priced higher than spot, reflecting storage and financing costs. Contango is the normal state for many commodities. The flip between contango and backwardation is not just technical trivia. It's a window into whether the market is relaxed or strained. Another fracture is the basis, the difference between spot and futures. When the basis behaves oddly, it can reflect financing stress, delivery demand, or dislocations between regions. And then there are premiums, the real-world price paid above the quoted spot price. Spot is a reference price for immediate settlement in wholesale form. Premiums reflect fabrication, distribution, and, during stress, scarcity of the specific product people actually want. Tightness tends to show up in these places first, spreads, basis, premiums, before it becomes obvious to everyone watching the headline price. Now connect the dots. The Silver Institute's numbers describe a market that has been structurally short for multiple years. At the same time, industrial demand is not just high. It's evolving into something more strategic. Why? Because silver has become a critical input in electrification and modern manufacturing. It's used in solar photovoltaics, electronics, grid infrastructure, EV components, charging systems, and countless industrial applications. And while efficiency improvements and thrifting can reduce silver per unit over time, the sheer scale of deployment can overwhelm those gains. One data point captures that scale. The World Silver Survey summary notes that China added a record 278 gigawatts of solar capacity in 2024. That's not a rounding error, that's industrial gravity. A pull that doesn't care about narratives. It just pulls metal through supply chains. Now look at supply. Mine supply tends to be slow moving. And in silver, that's especially true because a large portion of production is as a byproduct of mining other metals. That means higher silver prices don't instantly translate into a flood of new silver supply. Bringing meaningful new supply online takes years. Exploration, permitting, investment cycles, and development timelines that do not care about this month's chart. Even recycling, which can rise when prices spike, has limits. Recycling responds with a lag, and much of the metal is embedded in products that don't come back quickly. So the picture becomes clearer. Demand is structurally resilient and increasingly strategic. Supply is not elastic. Deficits have already drawn down buffers. That's how tightness deepens, quietly at first, and then all at once. Now add macro. Silver is not just an industrial metal. It also behaves like a monetary metal, sometimes. That dual identity is exactly why silver can be sleepy for long stretches, and then become ferocious. When macro uncertainty rises, questions about inflation, currency trust, geopolitical risk, trade disruptions, and financial stability, silver can attract safe haven interest alongside gold. But because silver is smaller and more volatile, flows can move it faster, harder, and with more violent overshoots. This is where psychological levels matter. Once silver is in triple digits, $100 becomes more than a number. It becomes a magnet and a battlefield. Round numbers are where headlines cluster, where margin calls cluster, where algorithms and discretionary traders both react, and where people who ignored the move suddenly feel compelled to chase it, which can accelerate both upside and downside. So the key question becomes, can the market hold above $100, or does it fail and retrace into prior zones? Some nearby price shelves have already been established by the recent move. Areas like the low 110s, the $150 to $105 zone, and the high 90s. These aren't magical numbers. They're areas where recent trading proved that buyers and sellers both cared. And momentum indicators matter here too, not as prophecy, but as temperature gauges. When RSI, the relative strength index, stays elevated, it signals strong momentum, but also warns that the market is stretched. In squeeze-like conditions, RSI can stay overbought longer than expected, and then unwind suddenly when the flow shifts. That's the personality of silver. Now, history. A careful comparison helps, but only if it's used responsibly. In 1979 to 1980, silver experienced an explosive run that culminated in a peak around January 1980 near the $50 area, followed by a dramatic collapse. The lesson from that period isn't a cartoon story about one event. It's the structural lesson. When liquidity is thin, leverage is present, and rules can change quickly. Price can overshoot and then reverse violently. Another useful reference point is March 2020, when market stress created dislocations across assets. It was including moments where physical premiums behaved differently than paper pricing. The lesson there was similar. The system can look orderly until stress reveals where the bottlenecks live. Those parallels don't guarantee outcomes, but they do explain why this market can feel calm until the day it doesn't. Now comes the part that should make anyone pay attention, because it cuts through the noise. A tight market doesn't need a conspiracy to behave violently. A tight market only needs a trigger. The trigger can be macro, it can be trade policy, it can be tariff uncertainty, it can be a regional scramble for inventory, it can be a sudden increase in delivery demand, it can be a funding squeeze, it can be a shift in investor positioning. That is a completely different question. This is where market mechanics become essential. Registered inventory is silver in an exchange-approved warehouse that is eligible for delivery against futures contracts. Eligible inventory is stored in the warehouse but not designated for delivery. Those categories matter because they reflect behavior, whether holders are willing to make metal available for settlement. Open interest is the number of outstanding futures contracts. It represents potential claims. Delivery notices indicate intent to deliver or take delivery. When delivery activity accelerates relative to available registered inventory, stress can build. KOT reports, the commitment of traders reports, show positioning by different categories like commercial hedgers and non-commercial speculators. Commercial shorts are often producers or dealers hedging exposure, but their positioning can still amplify moves in certain conditions, especially when a trend forces rapid adjustment. Then there are margin requirements. When volatility rises, exchanges can raise margins. That can force liquidation, even for participants who are directionally correct over the long term. And in extreme conditions, there's always the risk of cash settlement pressure, situations where settlement is influenced by financial incentives rather than straightforward physical delivery. Even rumors of this can shift behavior. Now, the bearish case has to be real, because if the only narrative is bullish, the market is being treated like a guarantee, and silver punishes that mindset. One bearish risk is demand destruction. If price rises too far, too fast, manufacturers look for substitution, redesign, or reduced usage. It doesn't happen instantly, but it can happen, especially in price-sensitive applications. Another bearish risk is forced deleveraging. Volatility leads to higher margins. Higher margins force some participants out. That can create sharp drawdowns even inside a broader uptrend. Another risk is macro reversal. If real yields spike, if liquidity tightens, if a sharp risk-off event forces liquidation across markets, silver can get hit hard because it trades like a high beta asset at the worst possible moments. Another risk is intervention or rule changes. Exchanges and regulators can respond to extreme conditions. Market structure can be adjusted quickly. That doesn't have to be nefarious. It can be normal risk control, but the effect on price can still be brutal. And there's always the simplest risk. Parabolic behavior invites overshoot, and overshoot invites correction. That bearish list is not optional. It's reality. Now, the bullish reinforcement is also reality, and it's grounded in the same thing that started this conversation: deficits, buffers, and marginal supply. 9 million ounce deficit in a single year has to source that metal from somewhere. A market that accumulates 678 million ounces of deficit across 4 years has already consumed a meaningful portion of its slack. 5 million ounces is not relying on a fragile one-week speculative impulse. Those numbers don't dictate tomorrow's price. They dictate the sensitivity of the system. When the cushion is thinner, price doesn't need a huge surprise to make a huge move. That's the core idea. Now, what does this mean depending on who's watching? For those holding physical silver, the key point is that physical markets and screen prices can diverge. Premiums can widen. Availability can tighten. Delivery timelines can change. The price is not always the price that matters when supply chains are strained. For traders in paper markets, futures, options, leveraged products, the key reality is volatility. Silver can move multiple percent in a single day repeatedly. Risk sizing becomes everything. The market can be right and still punish anyone who treats leverage casually. For long-term investors, the focus is regime, not candles. A structurally tighter market can support higher prices over time, but the path is rarely smooth. The difference between a good thesis and a good outcome often comes down to time horizon and risk management. For newer participants, the most important move is learning the mechanics: spot versus futures, contango versus backwardation, premiums, delivery rules, and why inventory categories matter. Without that foundation, the market will feel random, and randomness invites emotional decisions. Now bring it home. Silver tightness deepens when the market loses slack. Slack is the buffer between supply and demand, the part of the system that lets demand rise without forcing immediate repricing. When that buffer is thick, price moves are calmer. When that buffer thins, price moves can become violent. A multi-year deficit is a slow drain on that buffer. Record industrial demand is a persistent pull on that buffer. Slow supply response is a constraint on rebuilding that buffer. And when a trigger arrives, macro fear, policy disruption, delivery demand, regional scramble, the buffer gets tested. When the buffer fails, price doesn't predict tightness. Price reveals it. Now comes the verification mindset, because this is where credibility lives. The Silver Institute's survey numbers offer a baseline: industrial demand at record levels, deficits persisting, and cumulative shortfalls across multiple years. LBMA Vault data offers a window into London's wholesale holdings, useful not as a standalone enough metal indicator, but as a trend signal. And price behavior itself, the January 2026 move from the low 70s to the mid 110s, reflects the market's reaction to stress. The point isn't to adopt a narrative, the point is to read signals, spreads, premiums, inventory behavior, delivery dynamics, macro triggers. Those are the tools that separate analysis from emotion. And now, full risk disclosure, stated clearly. This is market education and analysis, not financial advice. Silver is volatile. It can surge and it can drop with little warning, especially around liquidity events, margin changes, and macro shocks. No outcome is guaranteed. Independent research matters. Position sizing matters. The difference between participation and regret is often risk management, not conviction. So here's the final message, the strategic core. The price is the headline, but the deficit is the plot. And when the plot is a multi-year drawdown of the buffer that keeps markets stable, the next big wave move doesn't require a miracle. It only requires one more moment where demand shows up and the marginal ounce doesn't.